Hello, everybody. This is AK. I'm back. So, I will think about the CPF from time to time, right? And I used to think about it a lot more actually, right? Because it is such an important part of my retirement funding plan, right? It's a cornerstone in retirement funding for me. And I have a blog post that says building a cornerstone in retirement funding with CPF. And I'll leave a link to that blog in the description box below in case you want to read. In a nutshell, right, the CPF will help us secure a measure of retirement funding adequacy. Because when we retire, we'll retire with number one, an investment grade bond, right? Access beyond the prevailing full retirement sum for our age can be withdrawn at age 55. So it is like a bond because you mature at age 55. And number two, part of that CPF savings would become a lifelong annuity called CPF LIFE that pays us monthly from age 65 for as long as we live till the day we die, right? So, I mean, it's easy enough to understand, right? And whether alternative investments or more conventional form of investments, they are not risk-free nor volatility-free, whereas CPF is risk-free and volatility-free, right? So this brings me to what you see on screen, right? In my screenshot of one of my blog posts, it says CPF is good for our portfolio. Right, it's good for our portfolio because it's risk-free and volatility-free. Then the next sentence says this strategy is dead. I'm not talking about putting money in CPF as a strategy is dead. I'm referring to something that has been going around in the last 1.5 years or so. Right, people saying that the 60-40 strategy is dead. 60-40 strategy refers to having 60% of our money in equities, 40% of our money in bonds, right? And this has always been conventional wisdom that we should hold some investment grade bonds in our portfolio. Because equities and bonds, the prices move in opposite directions, right? Usually. So it reduces volatility in our portfolio, price volatility, and it smoothens out the bumps, right, over time. But of course, in the last 1.5 years, what we saw was high inflation and rapidly increasing interest rates. And what happened is that threw a spanner in the works. We saw equity prices coming down, and we also saw bond prices coming down, both going down at the same time. At some points in time, right, in the US. So that's why the experts say 60-40 strategy is dead. But it only happens at during exceptional periods, right, in time. And that's when you have high inflation, high interest rates. Of course, bond prices would fall when interest rates go up so much. And then, of course, when interest rates go up so rapidly, then that also hits businesses, right? And that's why their stock prices also plunge, especially for growth stocks which have no profits to speak of, right? Tech stocks, growth stocks, whatever you call them, they have no profits to show, right? But if the bond component in our portfolio is actually our CPF savings, then we don't have to worry because with CPF there's no price risk. Right, because there's volatility free, it's very stable, it just pays us a coupon year after year, right, and it compounds year after year. So that's why CPF is good for our portfolio. It reduces volatility in our portfolio. And I have also blog posts in the past that says in some years, the CPF special account actually outperforms my investments in equities. It's true. And of course, there are other practical reasons why we should think of having more money socked away in our CPF account. And I will leave a link to that blog post in the description box below. The title is CPF is all we need unless we are very rich, right? And I also have a blog post called Why Have Bonds in Our Portfolio and Which ones should we have, right? So in that blog post, I talk about how it's important to have investment grade bonds in our portfolio and not just chapalang everything, like junk bonds, everything we throw inside, because junk bonds really do not move in opposite directions with the equity market, because junk bonds basically you are lending money to companies with very bad credit ratings, and chances of them going kaput would be higher. So when equity market suffers a downturn, usually junk bonds will also go down at the same time. So they go in the same direction, right? So the idea about having bonds in our portfolio is that prices of bonds and equities move in opposite directions, right? So it's only true if we are talking about certain types of bonds, right? Sovereign bonds as issued by AAA rated country like Singapore, or high quality investment grade corporate bonds would add stability to an investment portfolio, right? But of course there's still volatility, right? But they're less volatile in price, right? But then when you talk about junk bonds, is another thing altogether, right? Because when you buy junk bonds, right, in a bear market, stocks of weaker companies or businesses of the more speculative kind will get sold down more aggressively, and together with them, the junk bonds which they issued, right? Because Mr. Market is not worried about interest rate risk in such an instance. Mr. Market is worried about the risk of default, right? So if you buy the wrong bonds, then forget about stability, right? So that's all for this video. If AK can think about CPF, so can you. Bye bye.